With the VIX being down here, expected trading ranges being nothing, sometimes 25 points on the SPX, is the zero data expiration SPX trade dead, or can you still make it work? With the VIX being down here, expected trading ranges being nothing, sometimes 25 points on the SPX, is the zero data expiration SPX trade dead, or can you still make it work? Hey traders, I thought this was an apropos time to make this video. As you know, in our trading room, our live trading room, we focus on a lot of trades. We trade every single day, but the zero data expiration SPX day trade is one of our mainstays, and of course we trade that Monday, Wednesday, and Friday. This was Wednesday right here. Today is April the 15th, 2021. It's a Thursday, so today we once again ripped to all-time highs in the marketplace, but here was our day yesterday trading zero data expiration. And when the market opened up right here, we were talking in our chat room, in our live trading room, and the consensus really was that it wasn't a great day to trade this strategy, and it certainly turned out that way. I was just looking at our results here. If we look at the history for my SPX zero DTE trade, from Wednesday, we lost about $350 if you count in our fees and commissions, which really was an amazing success. If you think about the fact that I put up about $3,500 to $4,000 to do this trade, so I was able to limit my losses to 10-15% of my account value, which for iron condors is pretty darn good. But it was a mess. Wednesday's trade day was messy, and you can see that even though we tried to protect, we did all kinds of adjustments throughout the day. They did help, but they didn't help enough to get us into the positive. It was just a really, really messy day. And so one of the questions that we're getting a lot now, if we look at for tomorrow's example, the range, look at the expected range. So generally speaking, when you get a range that's down below 30, 35 points, again, that's reflective, of course, of what we're seeing in the VIX, right? Which the VIX, if we go to a daily chart, just absolutely getting hammered. There's no IV, there's no implied volatility in the marketplace. I'm pretty sure I can tell what the trend of that stock or what that chart showing me right there on the VIX. And it's just sucked out all of the premium. It's sucked out all of the volatility. We don't have a good expected trading range for the zero data expiration. And it just makes it much, much harder to trade it in a traditional manner, okay? In a traditional manner. And so what I wanted to do is start right out of the gate here with our failure on Wednesday, which I'm actually going to call a success. Holding, putting in a $4,000 order, holding my losses to $350. I think that that's a pretty good risk-reward ratio for the zero DTE. But I wanted to go back to our Monday trade, or my Monday trade at least, because I think that that day's trade will show you that if we can execute properly and if the market can cooperate, we can have stellar results with our zero DTE trading, even in this maybe suboptimal market environment that we are in right now today. So I want to jump in first of all, and I want to pull up the trades that I did for my zero DTE on Monday. There's quite a few of them. I bracketed them there here into 7 different separate transactions. So throughout the day, I had 7 different transactions that I went through, and let's take a look at those right now. Okay, so you can see right here, this is all of my trades from 4/11 through 4/13, so that would encompass obviously the 4/12 date, which was our Monday trading day there for zero DTE. And You can see that there are a lot of trades. I have to scroll down the page, but all of this equates to just, well, I say just, it equates to 7 trades. 7 different trades that I did throughout the day to capture, as you can see here, about an $1,100 gross profit. Now there's my fees in there, so it's really something more like a $900 profit at the end of the day. But I only used about $1,500 of capital. So on a horrible day in the marketplace, it was not a good day. This is the day that we're going to be looking at here. The premiums were low. This is Monday here. This is the April 12th time frame that we're looking at. So this is the day. Premiums were low. Expected ranges were low. It just looked like an ugly day. It looked very much like our Wednesday that we just experienced. But I want to walk you through this, and I transferred all of these so that I don't have to page up and down here. I transferred them onto a Word doc here so you can see those. We'll start with the first part of the day. So you can see there's actually, again, 7 trades. There's some trades at 7:39 in the morning, some at, and we can start down here, 9:18 in the morning, 10:40 in the morning, 10:52 in the morning, noon we did some trades, 12:01 we did some trades, 1:35 we did some trades, 1:36 we did some trades, and then 1:50, 10 minutes before the market closed, we did some trades. So there's a lot of stuff that shows on here, but they're all components of 7 different trades. So I wanted to start with the first one here, and we'll talk about this. This was the first one that we initiated. Now these times are all Mountain Time. That's my time zone, Mountain Time. So the market does open up at 7:30 in the morning. This was 9 minutes into the first trading session. You can see that I put in place an iron butterfly at 41.25. Now what is an iron butterfly? Well, this is an iron butterfly right here. Now this is not the exact one that I did at 7:39 in the morning, but it gives you an idea of what an iron butterfly looks like, where it's very much like an iron condor. We do have a short strike on the calls and a long strike on the call, short strike on the put, short strike on, or long strike on the put, excuse me. But the short strikes are right on the same strike price. Okay, and so it creates this very, very tiny tent here that you trade with, and you can obviously imagine that if this is your profit zone that we're working in right here, if this is our profit zone, that this is a very, very low probability trade, and it was in fact, I think, something around a 23% POP. Okay, 23% probability of success trade, probability of profit. So why would you do that kind of a trade? Well, this is a scalping trade. This is not a trade that we hold. This is a trade that we scalp. Okay, and scalp. Let me try that again. This is a trade that we scalp. This is a trade that we're just looking to grab a little portion out of the profits. And many times we can put these on for a $30 credit. And all we're looking to get out of this trade is $1 to $3. That's all we're looking to get out of it. So this is a scalping trade, okay? So that was where we initiated this whole process, and we can see this on the chart here. So here we go. Let's walk through this right here. This is our first go around. Right here, 7:39. We're going to put on the iron butterfly. And you can see that we put that on at 41.25 was the mid price on that. So at 7:39, which was literally right here at the open, we put that on at about 41.25. That would be right in here. Right in there is our first trade, number 1 trade of the day, iron butterfly. We put that on. And then number 2, second trade that we put on was at 150, and you can see that again right there, 150, and oh, excuse me, that's wrong. got this backwards here. Here's our next trade, 9:18 in the morning. 9:18 in the morning right here. We are buying back the iron butterfly. Okay, so at 9:18, we come back in here. Let's find our chart here. 9:18, that's right in this area. Maybe right in here. We're going to close that. And we closed it for a $280 profit. Okay, so we just took that off. We caught a little bit of theta on that. Again, this was about $1,300 is what we had committed to this trade at this point. Not too much capital. $1,300 of capital at this point. Okay, our next trade comes up at 10:40, and at 10:40 we're going to put a put spread in at 41.20. Putting in a put spread at 41.20. So at 10:40, which would be right in here, we're going to put in a put spread right here. So we sold a put spread right here at 41.20, and it was $1,000 of credit received on that trade. $1,000 of credit received on that trade, and at this point we were at $1,500 buying power. That's how much money we had put in the trade. So $1,000 credit coming in on just a $1,500 investment. The reason is because we were very, very close. This was a very low probability trade. Okay. Next transaction, you can see, didn't come too much later than that. That was 10:52. We're going to sell the call side now. So now we're selling the call side of this at 10:52, which would be right in here, right up at this level. We caught that pretty darn well at 41.40. So right up here, around 41.40, we sold the call spread. And on that call spread at 41.40, didn't affect our buying power at all. We didn't have to come up with any money because we've already put up the capital for this side of the trade, right? For the puts down here, the put spread. So the call spread up there at 10.52, no buying power effect, but we brought in $600 of extra credit on the trade. Okay, so that's our trade at 10:52. Noon, 12 o'clock noon Pacific, Mountain Time. We bought back the call leg for $300. So at noon, right here, we bought this back. We closed this out, bought it back for $300 cost. So at this point, we have pocketed right here. We've got $300 profit right here. Okay, sold the call, pocketed it, got it back in as things started to trail down. 12:01. Here's our trade at 12:01. You can see right here, this is trade number 4. We reopened the call legs at 41.35. So all we're doing is rolling these down in price. You can see that we're buying them back and then we're rolling them down. Okay, so at 12:01, we reopened the call legs at 41.35. So we were up here at, what were we at originally? We were at, let's look at our pricing here. We were at, on our call leg, we were at 41.40. We rolled them down 5 points to 41.35. Okay, so now we're down here around 41.35 instead of 41.40. This is our price now. That was our price there for the call legs. And we've rolled those down, and we reopened that trade back up again. Okay, at 1:35, you can see right here, at 1:35, we bought back the 4120 put leg at a loss of $1,100. Okay, so this put leg that we had put in place right here for a credit of $1,000, we had to pay $1,100 to get back out of. That was our risk management. You can see that things were starting to come down here in this trend, and we wanted to be protective of that. We were at the 41.35 level, or excuse me, on our put leg we were at the 41.20 level, which was right there, and so we bought, or let's just say this, let's put it this way, let's say that we closed the puts for a loss. Okay, part of risk management is knowing when to fold them and being willing to take that loss. Okay, so at 135 we bought back the put leg at a loss. At 136, so right after this, you can see we sold a new put spread for $300. So we sold a new put spread for $300, and the put level, the short legs, was at 41.15, so down 5 points. So now we're down 41.15 down in here, and what that time frame again was 136. So now we're right in here, and we sold it again at 41.15, so down in here. So new puts down in here. So we just closed the old one on the loss, opened up the new one, and that put spread we opened it up for a $300 credit of $300. Okay, and then we get to the fun part. Whoops, we get to the fun part here, the last part of this, and that is our last trade of the day, 1:50 p.m. So this is our last trade of the day right here, 1:50 p.m. 10 minutes before the close, we laid one of those butterflies on top of our trade, and that, let's see if we can find there's the graph of it right there. So this is where we're at going into the close. We've got our call leg here that is still open, our spread. We've got our put leg here that is still open, our spread. This is the new trade that we put in place right now. This is what we call an overlay trade, and we overlay this butterfly right on top of our existing spread, and you can see this sort of resulting, oh boy, well, you can see this resulting little tent that it creates as we look at this. There we go. It's trying. You can see the tent that it creates as we sort of build this out. That's what we call the tent right there. And that really boosted our income potential on the trade. And if we can get rid of this, let's see if we can get rid of that there. You can see that it really boosted our return potential because we landed right inside of that tent. So that was our very last trade of the day, right there at 1:50, 10 minutes before the market closes, and that would have been, let's go find the chart here, right in this area right here, and the tent was at 41.30. So right in this range right there, 10 minutes before the close, we laid the iron butterfly on. Now, here's what, again, is powerful about this trade. If you look at these numbers and you look at these results, and again, this is from my Tastyworks account, so there's no virtual trading there. You have to put in real money. You can't do fake trades. I never really went above about $3,000 to $3,500 at any given time in this trade. Started off the trade with about, as I said here, let's go back and look at it, about $1,300 capital here. It was pushed to about $1,500 here. So at any given time I had $3,000 at max tied up in that trade. and brought in $1,000 before commissions, about $800 or $900 after commissions. Any way you slice it, it's a really, really good rate of return. But that's not the point. The point is it was a really, really crappy day for zero DTEs. Now, there was a lot of machinations. There was a lot of movement in that trade. You don't want to have to do 7 different transactions in a day on your zero DTEs. But I just wanted to show you this video quickly to just, I guess, prove the point that even on seemingly quote-unquote crappy days, days where VIX is low, there's no implied volatility, there's no expected range, there's no premium in the options, that you can still make money with zero date expirations, but you've got to do a little bit different approach in terms of building out your trades. You'll notice that almost all of these trades were very low probability, high profit trades. And we either scalped a little bit of profit out of them, got a 30% capture rate at best, or we hightailed it out of it as soon as losses started to appear. Because these are not trades that you can sit in all day long. Anyway, I don't know if that was more confusing than helpful or not, but I wanted to share with you my experience from Monday because we could have used a little bit of that in our trading room yesterday on Wednesday.